You probably heard the phrase dollar cost averaging thrown around like it's some magical investing secret. Everyone loves to talk about it, and you've probably even heard about it from someone else as a good investment strategy. But here's the question nobody actually answers. Is dollar cost averaging actually worth it? Or is it just a strategy we tell ourselves is better so we can feel better about not going all in? I'm going to go over specifically this with real numbers, research, and a clearer answer. We'll look at what the data actually says, when DCA actually is a good option compared to when it fails, and what all this means for the average person trying to build wealth. By the end, you should have roughly a better idea of which strategy actually fits your situation. Let's start with the general basics. Dollar cost averaging, or DCA, is when you invest a fixed dollar amount at regular intervals. Say for example $200 every single month, regardless of what the market is doing. The price is up, you still buy. The price is down, you still buy. You're essentially eliminating the timing aspect of investing and just investing automatically. The opposite side of this is called lump sum investing, where you take a chunk of money and put it all into the market at once. Here's the thing that most people don't realize though. If you have a 401k through your job and contributions come out of each paycheck automatically, you're already dollar cost averaging. You're buying in at your retirement every paycheck regardless of where the market is at that moment. The real debate only comes up when you have a larger sum of money sitting in cash, maybe from a bonus, an inheritance, or selling a house, for example, and you're deciding, do I put it all in right now or spread it out over time? That's the big question, and the answer really is dependent on a case-by-case basis. Alright, let's see the stats on DCA, because there are real legitimate reasons people use it. The first reason is that it takes the timing pressure off. First, let me clarify, nobody, not Warren Buffett, not your financial advisor, and not the guy on social media that promises this is a new low for Bitcoin before it rallies back up, can consistently time the market. Studies show that the S&P 500 has delivered positive returns in about 73% of all calendar years since 1928. That sounds great, but what that means is roughly 1 in 4 years is negative. If you happen to invest your entire lump sum right before a crash, that's psychologically devastating. Considering that 2022 was the last negative return that's followed by 3 positive return years, statistically speaking, 2026 could potentially be the time we see another negative return on the year. However, DCA removes that fear. You're spreading your risk across time, so even if you buy some shares at a high point, you're also buying at a low point. A second reason is that the psychology behind it is real and it matters. Here's something behavioral finance has consistently found. The pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. This is called loss aversion. So for a lot of people, watching a big lump sum investment immediately drop 20% is not just uncomfortable. It causes irrational behavior like selling at the wrong moment thinking it will fall more just for it to rebound, because nobody can really predict the direction the market will go. Research from Morningstar found that the average investor in equity mutual funds underperformed the actual funds by about 1.7 percentage points per year, largely because of the poorly timed emotional decisions, which includes panic selling and buying back in at the peaks. If DCA helps you stay in the market and not panic sell, then the slightly lower returns might be worth it, especially at a time like right now, where we are at the peak and not sure if things will continue to rally or if we will have a market correction. A third reason for DCA is most people just don't have a lump sum to invest. Let's be honest, for most working class people, DCA isn't a strategy they necessarily chose. It's a necessity and out of convenience. You get paid usually weekly or bi-weekly and you invest part of each paycheck. And for regular contributors building wealth over decades, it works incredibly well. Okay, now let's take a look at the research and show the opposing side of dollar cost averaging, because the math favors lump sum investing generally most of the time. Vanguard published a major study examining market data from 1926 through 2015 across the US, UK, and Australian markets. Their finding was that lump sum investing outperformed dollar cost averaging in about 2/3 of all cases. Specifically in the US market, lump sum beat DCA in 68% of rolling 10-year periods. Morgan Stanley's Global Investment Office ran over 1,000 overlapping historical 7-year periods and found that lump sum generated higher annualized returns than DCA in more than 56% of cases. In an aggressive stock-heavy portfolio, the lump sum approach yielded about 0.4% more per year than DCA over 12 months. And a peer-reviewed study published in the International Journal of Management and Application backtested both strategies on the S&P 500 data from January 2002 to December 2022 a span that included the dot-com crash, the 2008 financial crisis, and the 2020 COVID crash, the result is that the lump sum investing still came out ahead in most scenarios. So why does lump sum investing win in these cases? It's simple. Markets trend upward over time. When you wait to invest money gradually, it's just sitting in cash. And cash earns basically nothing compared to equities. Every month, your money is just sitting there doing nothing, and you're statistically more likely to be missing gains than avoiding losses. Not only that, but with stocks that pay dividends, you are missing extra money that could be reinvested by DCA. As Vanguard put it, the longer your dollar cost averaging period, the greater the opportunity cost and the greater the lump sum's performance advantage becomes. Now, let's do some math so we can really see the difference between the two with numbers. In the first scenario, we have a person that dollar cost averages by default. This person decides to invest $500 per month into an S&P 500 index fund. They do this for 30 years, never stopping and never selling, even at huge drops in the market. Using about a 10% average annual return, they would have invested a total of $180,000 over those 30 years, but would have approximately $986,000. In a second scenario, we have a person that invests a lump sum amount. Now let's say this person inherits $50,000 at age 35. They decide to invest the full amount immediately into an S&P 500 index fund and leave it alone for 25 years. At a 10% average annual growth, $50,000 grows to approximately $541,000 after 25 years. So $50,000 turned into a little over $500,000 over a shorter time span. In a third scenario, we have a person that has a lump sum but decides to dollar cost average. Now, if this person inherited $50,000, but instead of investing all at once, they DCA'd and spread it out over 12 months, which would roughly be $4,167 per month. Using historical data, this approach likely yields about 2 to 3% less over a 10-year period than a lump sum, according to Vanguard's analysis. On a $50,000 investment growing over 25 years, that compounding gap could cost tens of thousands of dollars. But the most important part about this, if DCA meant the third person actually stayed invested instead of panic selling during a market downturn, then it would be worth it in the long run. Time in the market is really the most important part about this. But again, this is all theoretical statistical gains. Who knows what will happen with all the recent world events going on? So after all that, when should you actually choose dollar cost averaging over a lump sum? Generally speaking, this would include if 1. You're investing from a regular income, since if your money comes in paycheck to paycheck, there's really no other choice. It's just the best strategy for the circumstance, and you just automate your contributions. 2. You're new to investing and a big loss would cause you to quit and pull out of the market, because if you're scared that a 20% market drop would make you sell everything, then DCA is your strategy. It's about the long term, not the short term unrealized losses. 3. Market valuations are historically stretched. If the market's P ratio is at high levels like it is now, then gradually getting in would be smart. It's not perfect market timing, but it acknowledges the risk is there. And 4. The lump sum is large relative to your existing wealth. If you're putting in, say, $100,000 and your total net worth is $120,000, investing all at once is a huge psychological and financial bet. Spreading it out over 6 to 12 months can be a reasonable risk management tool, even at a small performance cost. Whether you're a lump sum investor or a dollar cost average investor, the most important variable is ultimately how long your money stays invested. The S&P 500 has historically delivered positive returns over 100% of all rolling 10-year periods since 1990, with an average 10-year return of 119%. The stock market has gone up roughly 73% of all calendar years since 1928. That means that roughly 3 out of every 4 years, the market rewards you just for being there. Because as the classic saying goes, time in the market beats timing the market. So, is dollar cost averaging worth it for you? For each person, it's a case-by-case basis and depends on your risk tolerance and financial situation. Not because it produces the highest mathematical returns. The data is pretty clear that lump sum investing beats DCA about 2/3 of the time when you have the money available. But most people don't have a lump sum sitting around. They have a paycheck and a savings, and DCA is the only option. And for those who do have a lump sum, if you can stomach the volatility and are not going to panic during a downturn, the research favors going all in. But if DCA is the only thing standing between you and selling at the bottom, then spread it out, sleep better at night, and stay in the market. Because the biggest investing mistake isn't choosing DCA over lump sum, it's doing nothing. It's sitting in cash waiting for the perfect moment that never comes while your cash devalues with time. Having time in the market is what actually builds wealth. If you found this helpful, drop a like and subscribe. Let me know what strategy you guys would choose, and I will see you in the next one.